ICICI Bank posted robust earnings in the fourth quarter of FY22. The second largest private sector lender net profit surged to 7,019 crores, a growth of 59% compared to the same quarter of last year. Though operating expenses increased, profit growth was driven by strong loan growth, solid margins, healthy fee income and lower credit costs or provisions, even as the bank showed up contingency provisions during the quarter. ICICI Bank has closed the gap with HDFC Bank on most financial parameters, whether it's funding profile, loan book mix, asset quality, provisioning buffer, capital position and most importantly, margins. But it's still trading at an 18% discount to HDFC Bank in terms of valuation. The best banks make market-leading margins, enjoy operating leverage gains, while spreading the risks through the credit cycle to deliver healthy and consistent profitability. HDFC Bank has done that for more than 25 years. The street finds ingenious ways to defend high multiples of such consistent growth franchises. And hence HDFC Bank enjoys premium valuation over all the other peer banks. ICICI Bank has undoubtedly regained its lost glory after successfully battling financial and reputational risks in the last decade. While ICICI Bank has come a long way, it will have to demonstrate its ability to manage credit cycle risks. Simply put, it will have to show the consistency in earnings growth similar to that of HDFC Bank. But can it do so? Given the clean and strong balance sheet with ample capital, the odds are clearly in favor of ICICI Bank delivering strong earnings growth in the coming quarters as well. Also, ICICI Bank seems to have learned a lesson or two from the past crises. For instance, the bank's decision to shore up contingent provisioning buffer in Q4 despite being in the pink of health highlights that the bank is well prepared to deal with shocks, if any, without denting its future profitability much. Precisely for these reasons, we see ICICI Bank's stock re-rating continue and valuation gap with HDFC Bank narrow down further. Also, the sectoral tailwinds in terms of better credit growth outlook and margin support from rise in interest rates should aid the stock's re-rating. The domestic loan book increased by 18% YOY, led by strong growth across SME, business banking and retail lending. Retail credit grew by 20% YOY. Corporate credit too saw good traction and increased by 10% year-on-year. Mortgages saw a 20% year-on-year growth. Other segments within retail, especially unsecured portfolio consisting of personal loans and credit cards, posted a very strong growth of 27% and 45% respectively. ICICI Bank's market share in credit cards business improved from 16% in March 21 to 21% as of February 22. The impressive performance in credit cards business can be attributed to its partnership with Amazon, which has enabled the bank to acquire many new customers. Overseas loan book also expanded by 10% YOY. Deposit growth was healthy at 14%, mainly driven by a 20% growth in CASA deposits. The growth in term deposits was relatively muted at 9% YOY. Fee income grew by 14%, driven by growth across various segments. Operating expenses increased by 17% YOY. Consequently, the cost-to-income ratio inched up above 40% level despite higher income. Operating leverage should show improvement with higher thrust on technology and digital banking. Asset quality also fared better. Net NPA ratio declined to 0.76%, which is the lowest since December 2014. Restructured assets too declined to 1% of advances book as of March end versus 1.2% as of December end. ICICI Bank carries a 31% provision on restructured assets, more than the regulatory requirement of 10%. Thanks to improving asset quality, provisions declined even as bank created contingency provision of 1,025 crores in Q4. The strong provisioning buffer will aid in containing the future credit costs and support earnings. ICICI Bank's stock has significantly outperformed Nifty as well as Bank Nifty in the recent years after almost a decade of underperformance compared to the peer set. The stock rally can be best explained in stages. With bad loan formation reverting to normal levels, the quick pullback in stock valuation was the first part of the story. In the second stage, investors can expect re-rating to continue with surge in earnings aided by strong top-line growth and lower provisions. At the current market price, ICICI Bank is trading at 1.8 times FY23 estimated core book value, which is attractive considering that ROA and ROE have inched up to 2% and 15% respectively. Moreover, bank's valuable subsidiaries continue to add shine to the stock's performance. In terms of relative valuation, following the rally in the past 1 year, ICICI Bank's valuation discount to that of HDFC Bank has narrowed. But it's still trading at around 18% discount to its closest lending peer, and hence there is room to further close the gap with HDFC Bank, which is trading at 2.2 times FY24 estimated core book value. Overall, ICICI Bank has well transitioned from a poster boy of stressed assets to a turnaround story to a growing lender. And if the earnings growth sustains, ICICI Bank is set to gain the coveted title of bank with the most premium valuation among the larger banks. Investors therefore should look at buying the stock.